So really my goal in today's presentation is really to touch upon two key things given the next 4 years. One, for those who are looking to partner with someone to help navigate the financial landscape, given the investments environment that we're currently in, I want to provide perhaps a framework for you to assess someone you want to work with to help manage your investments. And then secondly, at a very high level, I'm going to talk about what I believe is the type of investing style one should employ given the next 4 years and given the type of market conditions that we are currently facing. So with that, I'll start with my presentation. Did you share the screen, Ben? So sorry, here's my contact information. Feel free to follow, sending me an email directly at thuy.tran@KYUR.co. So moving on along with the presentation. So just a brief background of KYUR. We were founded around 2016. We are a registered investment advisor based in Newport Beach, California, in the heart of the Fashion Islands Financial District. We provide institutional level investment services for our clients. We invest in all types of asset classes, particularly equities, fixed income, as well as alternative assets such as crypto. Additionally, we not only offer traditional long-only products, but we also offer hedge fund strategies for accredited investors. And our clients, they typically are high net worth, business owners, entrepreneurs, individuals, and foundations. I thought it'd be helpful just to sort of tell you what an RIA is. I think there's a lot of different acronyms out there, and it's always not quite clear what each person does. So KYUR is an RIA. We are simply a registered investment advisor. So what that means is I have a license, it's Series 65, and I'm registered with the SEC in the state of California. As an RIA, I have a fiduciary duty to do what is in the best interest of my client. So your investment performance is my priority, and my fiduciary duty is make sure I generate the best returns for you. We're a fee-only advisor, which means that we would charge a fee of a percent of your account size. Importantly, KYUR does not hold your assets, right? We do not hold anyone's assets. We utilize a third-party entity that is insured by the SIPC. They hold all your assets under your name. They're fully protected by the government. KYUR holds no asset. KYUR is an active portfolio manager. So we're just like a Fidelity. We're just like a Capital. We have a team of managers and analysts who pick stocks, single securities, and we construct portfolios for our clients to generate investment returns. We're just smaller than a Fidelity. We're not a passive manager, right? We're not trying to mimic the index like a Vanguard or an iShare where they're just trying to match the benchmark. We don't do that. Nor do we allocate money to other mutual fund managers. Again, we pick all the single securities for our clients. The only big difference between us and Fidelity, size aside, is that the structure is our clients' accounts are in separately managed accounts rather than a mutual fund. And all that means is that each account we manage separately for clients under their name, as opposed to being able to buy shares in a mutual fund that you would at a Fidelity. That is a big difference structurally. However, our objective, much like any Fidelity portfolio manager, is to outperform the S&P 500 over a full market cycle, which we define as 5 years. So that is what we do. That is our core focus: manage portfolios, generate investment performance for our clients. You know, one thing I forgot to add before in terms of KYUR's ultimate mission is really our goal is for our clients is to help them build a financial legacy, not just for themselves, for their children, their future generations. We recognize that your financial legacy is one of the most important things you leave for your family. And so we take great responsibility to try to generate that, not only preserve it, but to help it grow over time for our clients. So if you're looking to partner with an RIA, help find someone to help you navigate through the current environment, we've kind of developed a very simple framework, which we call the 7 Ps that we suggest people look at when evaluating the manager. And these are the 7 Ps in order of, I would say, importance. First of all, is portfolio management experience, perspective, performance, process, their product offering, pricing, and protection. And I'll touch upon those a little bit through the presentation. Let's start with the first P, portfolio management experience. Much like any profession, if you're getting an operation or you're getting your taxes done or you have a legal case, you generally want a professional who has experience, right? Who's done it, who's seen the good and the bad. And so in myself and our team, we have over 20 years of investment experience. I have about 20 years of investment experience. I've managed global equity portfolios during that time. I can credibly say that I've managed in every equity market in the world except for frontier markets. I've done US, Europe, Asia, emerging markets, and whatnot. And so I have a very diverse investment experience in terms of asset classes and markets. So I think it's very important, even managing a domestic portfolio. One thing I will point out is as part of the portfolio management experience, the actual years is really also, where they worked, and also academically. I think academically where they've gone will show you the type of academic training they received to ultimately put that in practical work environment. And so, I went to school on the East Coast. I went to a boarding school called Choate Rosemary Hall. Its most famous alum is President John F. Kennedy is an alum, so it's most famous for that. Subsequent to that, I went to NYU Stern School of Business. I really wanted to pursue begin a career in business. My first job out of school was was a commodities trading commodities for AIG, which is a great introduction on risk management and sort of the psychology of markets. I decided I wanted to transition into the investment world, and hence I went back and got my MBA at the Warren School of Business at the University of Pennsylvania. And while there, I was chosen to be a Warren Fund Fellow by Warren Finance professors, really to manage a part of the endowment for the school. So the great practical training ground combined with the academic training at Warren. So I was a finance major. After that, I cut my teeth working at several large established money management firms in New York City, notably Neuberger Berman, which is a large firm in Midtown Manhattan, and then Man GLG, which is a very large hedge fund manager based in the UK, but I worked in the New York office. During that time, the funds that I helped manage received very high rankings from Morningstar. And so over the last 15 to 20 years, I've managed through different types of markets. I've managed money through the great financial crisis, the EU banking crisis, China debt concerns, certainly COVID, and then the Fed tightening cycle. So I've seen a lot, and I think that's part of the portfolio management experience, coupled with the academic training, is what I would suggest you look at when you're trying to evaluate somebody to be an RIA. So, and why is that important? Why is experience so important? And that takes me to the second key. Experience provides you perspective, right? And so we define a full market cycle as 5 years. And so each market cycle is different. Stuff happens in the world since 1960, the major economic geopolitical crises globally since 1960, and you can see that on the chart. Despite this, over the last since 1950, the S&P has returned about 10% cover. Now, I can't predict the next 4 to 5 years, but I do know historically, the market does correct, and I think corrections are healthy. I think it reduces excesses in the market, and it provides a foundation for the stronger companies to emerge and continue to grow. And so, just to provide you some perspective, I think the factors in place to be optimistic about the long-term growth of S&P is still in place, right? I think technology, AI is not going anywhere. The baby boomers continue to spend on healthcare and other lifestyle goods, and there's a huge generational wealth transfer going on between the baby boomers and the next generation. So I think all those things are certainly supportive of continued long-term growth. But really important is the perspective is, invest for the long term. Don't focus too much on any one month. any one quarter. Don't forget, these last 5 years have been incredibly volatile. Right? We went through COVID. We went through the Fed tightening. Uh, the market's down about 10% this month. Back in March 2020, it was down about 12%. Right? So the last 5 years were just as volatile. It's just been a very short-term memory. The last year has been quite healthy, but the last 5 years have been incredibly volatile. And one thing I will say about the perspective, no full market cycle is the same. But the one thing that is the same, no matter what cycle it is, it's market psychology. Greed and fear always comes back. It's just human nature. And what that perspective teaches you is to recognize where are we in that psychological meter? Are we risk on? Are we risk off? Are people scared? Are people greedy? And by understanding that, seeing that, those repeat, those cycles always repeat. And understanding those allows you to decide when to take more risk and when to take less risk. So now we're on a risk off mode, right? And so that means perhaps having more cash in the portfolio because the market is worried. But that is what perspective gives you with the experience, right? Another part about perspective and something we've learned over time is we're actually not money managers. We're actually a risk manager, right? You've given us assets to manage, and our job is to kind of mitigate the risk as much as possible, right? We're going to try to grow it for you, but our job is to manage your risk, your financial risk, and that's what we try to do. So for us, the investment process begins with a very proactive risk management framework. We always ask ourselves, not how much money can we make, how much money can we lose on this? We start with that fundamental question first. And then we said, okay, that's how much we can lose. How much can we make? And what we're trying to do is find attractive risk reward profiles. What does that mean? We look at an investment, maybe if we're too early, maybe we, but if we're right, we make 40, 50%. Right. So that's kind of a 4-to-1 ratio. And those are the type of opportunities we're trying to identify. Right. But it begins with a robust, active risk management framework. The founder, the CEO firm's mantra is the key to optimal investment returns control over risk of capital losses. Right? Rigorous risk control better protects investors in market dislocations, thus giving investors a peace of mind and effectively increasing long-term returns by minimizing the catch-up periods and recoveries following market corrections. So what does that mean? When the market's down, you want to try to preserve as much capital as possible and lose less. And when the market bounces, you can participate, right? So that's really what we're trying to do is finding attractive risk-reward profiles so that we can take advantage of these types of opportunities when the markets bounce and protect our portfolio when they go down. So that is probably the biggest takeaway in terms of perspective. We are opening with risk managers. That's how we look at everything. That's a lens we look at everything. Now, if you have the first two P's, portfolio management experience and perspective, you should see it in performance, right? And so that's the third P. If you're looking in RIA, how have they done? And again, we recommend evaluating someone over full market cycle, which we define as 5 years, because it's simply impossible to outperform the market every year. It's very, very hard. There are very select few hedge fund managers that can do that, but most can't. So sometimes you'll be underperformed, sometimes you can outperform. But over 5 years, what you hope is that the manager will outperform over that cumulative time period, because that's a true reflection of their skill as a manager. So at KYUR, our flagship strategy over full market cycle 5 years has outperformed the S&P 500. Over time period where, according to the S&P Global, 77% of large cap managers, i.e. the Fidelities of the world, have underperformed the S&P over 5 years. Right? So again, it shows you if you have the experience and you have the perspective, it should show up in performance. So, and that is what we're paid to do, is generate performance relative to an index. So if you're looking at evaluating an advisor, those are the first three P's I start with: portfolio management experience, perspective, and then ultimately performance. Once you're comfortable with that, there are other important considerations to the next tier of issues or questions you should ask yourself, which takes us to the fourth P, is process. How do they invest? There's all types of ways to invest in the world, and people speak different types of investment languages. Sometimes they're growth, sometimes they're small cap, sometimes they're value investors. So you need to be able to speak with your advisor and speak the same investment language and have a sense that you can communicate. That is ultimately the most important thing. So it's important for you to understand what type of investing profile you have, your risk profile. Are you high risk, low risk, are you conservative, or big growth? And once you identify that, try to work with someone who aligns with those types of risk uh, levels that you have. That's incredibly important. So, you should really have a discussion with them to understand how they invest money, how they do risk, and whatnot. At KYUR, we implement a quantitative investment strategy. It's proprietary. I began my career as a fundamental investor, but over time, I believe quantitative investment is just more effective, in part because the market is really, really efficient now. And so it's really hard to get an information edge unless you work for a very, very large firm, a lot of research analysts. So we employ a quantitative investment model to choose our stocks. And very simply, through our investment careers, we've identified certain stock factors that we think drive stock performance. And we try to identify, the model identifies stocks that have those stock factors. And very simply, what we're trying to find is inflection points in the key profit drivers, whether it be sales, gross margins, operating margins, and the ultimate impact on earnings, right? And so the model is trying to identify from a quantitative basis potential inflection points in those key drivers, and then ranks those stocks for us and presents them to us. And that is a stock that we put into the portfolio. So what our founder likes to say is we like to capture, what we call catalytic momentum, or the value warp. So what that means is if you're going along, you're trying to find, if you see the arrow here, we're trying to find an inflection point where earnings is driving, it's changing. We're trying to capture that upward slope. Sometimes we get it right on the inflection point. Sometimes we don't. Sometimes we get in the middle. But the idea is you kind of ride that slope upward, and the momentum continues to increase as earnings continue to deliver. And we're trying to capture that. And then we try to get out before that negative inflection where it comes off again. So that's what we do. I think the beauty of this system is incredibly objective. There's no emotion. It's repeatable, and more importantly, it's scalable. So this is a quick diagram of just how it works. We have the model. That model looks at the S&P 500 primarily. It looks at certain stock factors that we think are important, and then whittles it down to an investable set of stocks. And we ultimately pick around 50 stocks at most, and the average stock position is anywhere between 1% to 5%, depending on our conviction. And ideally, we're buy and hold investors looking for long-term businesses, long-term franchises with competitive moats, where we believe the earnings growth is sustainable and defensible against the competition. So we're very much buy and hold. We're not trading in and out. We have a long-term investment horizon when we buy these positions. So that's the investment process. So again, your advisor needs to be able to talk about how they invest, and it should resonate with you and fit kind of how you think about investing and how you think about risk. Now I'll touch upon a point, just points from the 5 and 6P, and it goes to products and pricing. Given my view of the next 4 years of volatility, I think it's important to partner with an RIA that has a couple tools to navigate the storm, right? And it's kind of like picture yourself in a boat and there's a storm, and you need a compass and a telescope, but maybe he only has a telescope, right? And so we like to have a compass, a telescope, and something else, right? The idea is to have different types of strategies that can help you navigate the market. And what do I mean by that? So we offer a traditional long-only product that typically benefits when the market goes up, and will go down when the market goes down. But we also have other alternative strategies that will benefit when the market goes down. What does that mean? We can short stocks that will go down in the down market and actually make money on them. Now, those are only for accredited investors. But that said, together, we can put together these types of total wealth solutions. So when one strategy zigs, the other one zags, right? As opposed to just having one strategy kind of standing on its own. And I think going forward, that will be incredibly important to have kind of the compass and the telescope in your holster to manage the choppy waters of the next 4 years. I mentioned before, I worked at GOG Man, which is one of the largest hedge fund managers in the world. So I not only managed long only strategies, but I managed hedge fund strategies there as well. So I like to think I have a compass and a telescope to navigate through the storm right now. An important thing also to consider is the fees. So we at KYUR, we pick all our single stocks, right? And so we only charge one fee as a percent of assets, as opposed to other RIAs who actually may allocate your money to external managers. And by doing so, the client is effectively paying two investments. You're paying two fees. You're paying to the RIA, and then you're paying a fee to the manager managing, external manager managing the money. Now, when the market has been up 20%, you probably won't mind so much. But if trends are a little bit less for the next 4 or 5 years, that extra 1.5% you're paying on top of the management fee will make a difference and will add up. And so again, when you're looking at an RIA, try to understand their fee structure. Like, what are they charging you? Are they selling you other products? You know, what is in that fee? Again, at KYUR, we only charge one management fee, and that's it. We don't sell you anything. We only charge you the one fee. And then finally, what I'll add that as KYUR, we're an independent firm. So we're not affiliated with Merrill Lynch or Morgan Stanley. And so we're fully independent and do what we think is best for our clients. Right? We're not going to sell you other products to make money off of you. Right? So I think you want someone who's independent, again, who has that fiduciary duty to do what's in your best interest. So again, the fifth and sixth P, when you talk to this player, what type of products do they offer? And then two, what is the pricing on those products? That's very important to consider. And finally, the seventh P is protection. And again, most people who invest with RIA won't have this problem, but perhaps for overseas listeners, and I just mentioned it, given some of the recent crypto problems from a year or so ago, where are your assets being held, right? Understand that. They should be held by third-party custodians. So in the case of KYUR, again, we don't hold any assets. We employ a third-party custodian. In the case of Interactive Brokers, and they hold your assets under your name, and they are SIPC insured. You have full control of the account, full visibility. You see all the trades, and you have full liquidity. You can liquidate it very quickly and get it when you need it. So again, that's another important part. Are my assets protected? Can I get them? Can I see them? Again, that's something you should consider. So that is the seventh P. And so the final P, which I haven't really talked about, the final P, and probably the most important P, is partnership. When you're working with an RIA, do you think you actually have a partnership with them? And what does that mean? Do you feel like they hear you? Do you feel like they understand your investment goals? Do they listen to you? Do they take time to talk to you? Do they speak the same investment language? Right? Because this is not a 1 year partnership. It's a 1, 3, 5, 10, 15-year partnership. And they have an important part on your future. And so you really need to feel when you're talking to an RIA, do I feel like I can be a partner with this person? Right? From KYUR's perspective, we've seen a lot of growth because a lot of clients are frustrated working with a big box advisors. They charge similar fees as us, but they don't get the performance and they don't get the access, right? They call the number and they speak to a different person each time they call, or they don't even know who their advisor is, right? You don't have that problem at KYUR. You speak to the people who are actually managing your money. They have 24/7 access to you manage your money. And so we try to provide a white glove service as most clients deserve, given the assets and the money they're paying us. And so really ask yourself, do I feel I can form a partnership with this person? And I think, this last P is probably the most important. I would sometimes tell you, I would take a great partnership, even if that manager perhaps underperforms the S&P, because I think that's more important. So again, that is very important. The final P to consider when you're looking to evaluate and work with someone, which I think is important given the next 4 years, and I think the volatility that we will see going forward. So again, it's portfolio management experience, it's perspective, it's performance, it's process, it's products, pricing, and then finally protection, and then the real deal of partnership. So how do we invest going forward? What to do? Where's the market going? Short answer is I don't know. But, let's look at history. So this is a look back at the chart. Again, the market has been through some very difficult macroeconomic, geopolitical, existential issues and has managed to always kind of recover. There've been very large peaks and valleys, right? I understand that. But again, that's when you long-term view and recognize what we're going through now is not uncommon, right? So please keep that in mind, especially with a full market 5-year view. I'll touch briefly upon what's going on now and sort of what is the motivation of the current administration. The short answer, I don't think anyone knows. It's speculation. We don't know ultimately what these tariffs will mean, how watered down will be negotiated. So it's still very much a work in progress. But it's definitely a risk off mode. And we've seen that before. I think just to kind of keep it objective, I've spoken to people much smarter than me, and they say, well, he's doing this, one, because he wants to pay for future tax cuts, and two, perhaps increase domestic manufacturing, which seems reasonable. But we'll see. But what I do know, and as we look at this chart, is we are resuming a process of deglobalization that first started in 2016 with his first administration, that was put on pause during the Biden administration, and then clearly he's going full-fledged pedal to the metal acceleration to get this through. So from an investment perspective, what does that mean? So we're going to have deglobalization. What that's going to happen is there's going to be increased competitive dislocations within sectors. What that means is there's going to be winners and losers emerging from an investment perspective within sectors, right? So that's how we approach it from an investment perspective. We're not going to try to figure out where the market's going to go with it. And we think about it clearly, we're very macro aware, but we always look at the investments and what does that mean? And so for us now, it's really identifying, stepping back and identifying where there are competitive dislocations from an investment perspective and what that means. So there's two takeaways with the competitive dislocations. First of all, sector allocation will matter, right? A typical passive strategy will own all sectors. I don't know that's going to work now, right? Now is the day where you want to make sure the right sectors, you're in the right sector. So what does that mean? So this chart really shows you kind of within a sector, for example, we'll say in IT, historically, the best performing stock was up 175% and the worst stock was down something less than that, right? So intra-sector dispersion, i.e. the difference between the best performing stock and the worst performing stock in the sector will increase, right? But that provides investment opportunities. And so we expect increased intra-sector dispersion and also picking the right sector. So, normally right now, you probably don't want to have much of industrials. If you own consumer discretion, you have to be careful because you have to see how much they import, right? So sectors matter. You just can't own the market like a passive strategy, own everything. You have to decide what sectors you want to have money in and sectors you want to avoid. And that requires an active approach. The second key thing is stock selection will matter. Again, winners and losers will emerge from the deglobalization and the competitive dislocations that we anticipate over the next foreseeable future. And so as part of that stock selection, I think there's kind of qualitative criteria that we will be looking for, really identifying the winners and the losers as time goes on. So briefly, what is a winner profile? We'll be looking for companies with the visible backlogs, order books. They have recurring revenues. They're exposed to secular rather than cyclical capital. They have pricing power and inelastic demand, what we call sort of defensive earnings growth. And if times do get tough, they have the ability to self-help, i.e. reduce their cost base to help maintain their profitability. Something that big tech did in the correction of 2020 and 2022, where they started laying off all their high-priced engineers. So even though top line slowed down, they're able to maintain profitability, reducing the cost base. We'll see more of that. And where there's still pockets where demand exceeds supply, you want those types of businesses. And then you'll see that there will be sustainable earnings revisions, right? We'll see that the winners will exhibit that types of earnings profile. Now, the losers are probably the exact opposite. They're going to be exposed to cyclical capex, right? They're going to be exposed to GDP growth. They have no pricing power. They have a commodity product, or they can't pass on the tariffs. They'll have to accept those, and that will hurt their own profitability. And we'll see that again through negative earnings revision, right? And so what we're trying to do is capture what we call the crocodile jaw, go along the winners and avoid the losers. So from an investment perspective, the next 4 or 5 years means sector allocation matters and stock selection matters. You just can't buy the market and say, you know what, I'm going to make money. You have to be very disciplined, have a framework, and know what type of company you're buying and why you're buying it. And ultimately, earnings will matter. I think the last couple of years, it's more, they've been seeing some stocks where it's been the potential this, the potential that, and the earnings will ultimately catch up. And hence, you had very high valued stocks. That's not going to work. The market will want to see earnings growth. They want to see sustainable earnings. They want to see visible earnings. The market will pay a premium for stocks that say, you know what, we're going to make money this year. And the market will pay for that type of visibility. Even if the growth isn't that sexy, let's say 10 to 15%, the market will reward that with a higher multiple. We've seen that time and time again, and we'll see that again. The market will buy stocks that it thinks has a defensive earnings profile or can sustain what's going on currently. Those that do not make money or have lost money will get hurt and will be penalized. All right. So again, it always goes back to the earnings. Earnings drive stock prices. And now earnings will matter in any investment you look at. And I think our model in particular helps identify companies that we believe earnings are sustainable and or improving, and hence we can benefit from them. So given that sector selection and stock selection matter, what type of investment strategy should one employ in this environment? So we believe going forward, you should employ a combination of an active and, for those who are accredited, alternative strategies, i.e. the ability to long short stock. What's not going to work is a passive strategy. So this is a very simple chart, right? The S&P has 500 stocks. A typical passive strategy, i.e. a Vanguard ETF, will simply mimic that. So it'll have 100%, it will have 500 stock or 100% of the stock to the S&P. Meanwhile, an average active manager, like a Fidelity, will have anywhere from 100 to 200 stocks. Or in other words, it will own the 20 to 40% of the S&P. Again, that's just too many. I think, that 100, 200 stocks is a big number that may not be able to do well. In this case, in this market, less is more. And so KYUR employs a 40 to 50 stock portfolio or 8 to 10% of the S&P, right? I think to be able to find your best 50 ideas in this environment is tough. Anyone who goes beyond 50 stocks is simply diluting the return profile for their clients and simply just trying to mimic the benchmark for their job security. So you want a manager who's willing to take a little bit more active risk, take high conviction bets based on the framework upon which I've just outlined, and then hold these stocks. That over time will work. Now, we've employed that over the last 5 years, and that has worked in terms of generating performance that has outperformed the S&P 500. We believe that will continue to work. And then from a long short perspective, again, I think being able to short stocks, additional long stocks will be incredibly powerful. And what that simply means, there are going to be a lot of losers right now, right? And obviously we've seen stocks being clobbered on the back of a perception of being losers, and maybe they will, but a long short product allows you to short those stocks and make money when they go down. So really, ideally, a combination of the active and the long short strategy, I think is what you would like to have. For those who can do it in-house as opposed to outsources is also incredibly important because one, from a fee perspective, right? So, you will pay less in fees. But I also believe in this market, you have to be incredibly nimble, right? And so if I'm an advisor and I have allocation to 5 different mutual funds, I know what they do, but I don't know the stock. I don't know exactly why they own them, right? So if I'm trying to de-risk and raise cash and make my portfolios more defensive, it's harder. Like they don't exactly know what they own, right? In the case of KYUR, we know what we own. We know why we own it. And so we sell or buy something, we exactly know. So we can quickly reposition portfolios, be very nimble in this type of environment, which again, I think is very important. Smaller is better. You want to be nimble, you want to be moved, you want to adjust as needed. And so again, these are the two things, type of strategies I would, approaches I would recommend going forward. And then I'll just end here with a disclosure. Again, this is for informational purposes only, but again, this is a disclosure of just what I've spoken about. And then finally, again, I'm happy to speak to anyone who wants to just talk about the markets. I'm happy to review your portfolio. Just happy to have the conversation, talk about your financial goals, the type of financial legacy you're looking to leave, and really, to partner with you. I think managing someone's money is a deep responsibility and a credible honor for people to trust me to do that. So I don't take it lightly, and I'm happy. So I take it very seriously, and you know, I always say I manage my clients' money like it's my mother's money. So that's all I can say. That's what I try to do. And so feel free to reach out to me about email. I will follow up, and always happy to have a follow up discussion. And that's that. And thank you for your time.
All right, thank you, Thuy. Thank you for such a wonderful presentation. I know this is very unique. Please raise your hand, and we have a few minutes to answer those questions. And I think this is an important topic because a lot of us we are very scared about the market, especially right now. Right?
Right. I think somewhat. I mean, the last 2 years have been easy, right? I mean, I think everyone has felt really smart. Because their uncle bought this or their dad bought that, and it went up, and everyone felt like the smartest person in the room, and it should be. Listen, it's still hard to generate returns, but what you saw there is, it's kind of like it's like kind of owning. Even if you own the worst house in the best neighborhood, it's still going to go up in value, right? That's kind of what investing in the stock market has been like the last couple of years. And now we're in an environment where you want to buy the best house in the worst neighborhood and the best house in the best neighborhood, i.e., quality matters, right? And stock selection matters. And frankly speaking, I do my taxes when I have to, right? I don't like it. I understand taxation, but sometimes, you know what? I can't. It's just too hard. I give it to a CPA.
That's right.
Right. And because, a little bit of knowledge is dangerous, is what I say.
That's right.
And I will tell you, it's a professional investor's market, right?
Mm-hmm.
It's kind of like sitting down at a poker table and you're playing with pros and you're the amateur. That is the environment we're in. That is how I would think about it. You're sitting at a table full of sharks, and it's a professionals market, and it will be a professionals market for the next 5 years. Last 2 years, it's been a very passive market. What does that mean? It means if you simply own the index, you would have made money, and that's fine. And that's a market cycle. That it was a function of that. That was a part of the market cycle. People forget that before those last 2 years, we had COVID, we had the Federal Reserve raising rates, the markets went down 25% that one year, right? So people seem to forget that markets go up just as much as they go down. And it's really hard to navigate it. And I think it will be incredibly harder to do that. Because frankly, it is a full-time job, right? It's a full-time job. I mean, just reading the headlines is not the way. It's very hard to manage money that way. It's a full-time job that takes dedication, takes professionals, and it goes back to what I talked about risk management, right? I think people, again, they always think, how much money can I make? Which of course you have to think about that, but start with how much money can I lose? Think about that first, and then start that. So, and I think that is an important mindset, but I think it's a professionals market. I think active strategies will underperform. I'm sorry, passive strategies will underperform. active managers should outperform in this environment over time, right? So
Mhm.
it is very scary. Again, remember that chart I showed you, and I'll go back to it briefly. Again, just to give people some comfort out there
Yeah.
that we've seen this before. It's not market corrections. They stink. I'm not going to say they're great, but they can also be in a world in a way healthy. I think people will recognize there's been a lot of excess demand built up the last 2 years, right? All these guys with Instagram investment channels and how to make money 30% in one day, right? My phone's full of them, right? Instagram's full of these quick streams about you buy the stock, you make 20% in a day. That's not investing, right? And that is simply a product of greed, a product of excess, and we've seen that before, right? And so we recognize again, it's human psychology. Now the market is very scared, and I understand why, and I'm not sure where it's going to go, right? But I will tell you, history has shown fear provides opportunities to buy quality companies at good prices,
That's
right?
right.
Where maybe they'll be hurt at the margin, but we typically stick with large cap companies as opposed to small cap. And typically in these types of macro corrections, large cap stocks actually further enhance their competitive positioning, right? Because the smaller competitors can't compete. They can push them out of the market. So the stronger get bigger and the bigger get stronger in these market corrections. And that's when you start to accumulate them. So when things get better, they simply just crush the competition, right? So I think that's what's going to happen. You're going to need to be big. You're going to be able to withstand it from a profitability perspective. You're going to need the lobbyists to lobby for you. You're going to need a cost base to offset any decline in sales in the back of this. But these guys will survive. History has shown they will survive, right? And so you find the right part, you find the right place to start buying them. You look for the risk reward where you get 10% down and 50% upside. I don't know if we're quite there, right? It's probably maybe 15, 30, 15, 40, but we're getting there. We're getting there, right? So, so that is what we're trying to do. And again, look at that chart. We've been through a lot. The world's been through a lot, and we've done okay. So again, that's perspective. That is what a experienced fund manager provides to you. Is that we've seen it before. We know what to do. We're gonna navigate this for you together with you and get you where you need to go. So that's why I think the experience and perspective is so important now. And it's really when you talk to somebody, really dig into that. Like how many the best lessons in investing is when get your ass handed to you, right? So that teaches a lot of valuable lessons. And one day you think you're the smartest person, the next day you're not. But you need someone who's gone through those processes to feel the pain of the market down 10% and what to do because right now it's an incredibly emotional market, but you need someone who's unemotional,
Mm.
right? Someone who can sit back and not get emotional. And unfortunately, when you manage your own money, you get emotional. I understand why.
Mm.
It's your money. You look at it, oh my God, it's down, and you sell, and that's human emotion,
That's
right? And sometimes I think it's good to work with someone, a professional who's unemotional, who can say, you know what, it's okay, we'll do this, we'll do that. But you need someone, I think, in this environment to be that unemotional person on your shoulder to help you to get through this volatility. But again, as history has shown over time, if you're a long-term investor, things correct, they're healthy for the market, and things resume their growth. And I think the long-term trends, technology, the baby boomers, healthcare, generational wealth, are still in place. And so I'm still optimistic for the long-term view.
awesome. So thank you, Dewey. I believe you bring very good value added information to the community. And I believe that this presentation it's worth it to hear it again. Maybe in the
Sure, no,
future.
happy. I may change my tune in a month. I'm always happy to hop on. I think it's no, always happy to be available. Happy to do a monthly call. Whatever
Mhm.
you think your audience will help. I'm sure each month I'll have something different to say. We'll have more information,
Sure.
right? But I think again, this deglobalization thing is not going away, and so we're trying to still figure out the investment ramifications because we don't have all the details.
Mhm.
But again, it's a good market for active stock pickers, professionals like me, where we can find the winners and help our investors generate returns over the long term. So these create opportunities. It's painful, but everyone hang in there and again, just look at that chart. The world has
Yeah,
gone
that's
through
right. 10% is not too bad.
no 10% a year since 1960, right? So we've gone
Yeah.
through a lot of stuff,
Mhm.
arguably much worse than we're having now, right? I mean, the financial the financial market, the financial condition of households is still better than back in the GFC and the SNL crisis. So we've been through much, at least I mean, definitely probably worse. I mean, listen, it was just like the mindset now isn't much different than COVID
That's right.
in the sense that the panic level, right? People didn't know what that meant, right? And so the price action, for example, we're down about 10% this month. The last time we were down this much was in March 2020 during peak COVID fears, right? So obviously the macro environment and the geopolitical is very different, but the emotional mindset is very similar, right? And so we recognize that, and that means we're in a risk-off mode, and you position your portfolios accordingly. But just remember, that was only 5 years ago, not even 5 years ago to the day, to the month, right? Where we had COVID, right? And think about then. So
Yeah,
that was only 5 years ago. And so we've seen it before, we survived. Um, and again, just keep that in mind.
that's right. All right, so it seems like there's no more questions, Dewey. I appreciate your time and everybody's time. I know the time is valuable, and we appreciate it. So with that being said, I will say thank you, everybody. Have a good rest of the day, and enjoy your Saturday. And I'll
Thank you so
see.
much. Thank you for
uh,
the audience. And again, always happy to talk.
that's right. So I
Thank you
will
so
keep you
much.
posted for the next presentation to everybody.
Perfect. Yes, happy to speak again whenever it makes sense for the audience. Thank you
All
so
right.
much.
Thanks, Dewey.
Take care, everyone. Goodbye.
Goodbye now.